Lovely. Well, thank you for that warm welcome, and thank you, David. It's a pleasure to be here. I always enjoy coming to Auckland. I'm privileged in my job that I do get to travel to New Zealand quite a lot. I'm here sort of 5 or 6 weeks of the year, so it's one of the big perks of my job. Now, maybe just a quick background on Rabobank for anyone who's not familiar with us. We're about 110 years old. We were formed by Dutch farmers in the Netherlands. And unlike most banks, we are actually a cooperative, so we don't have any shareholders. Nevertheless, we're quite a large bank. We have around about $900 billion in assets, and we operate in many countries around the world, including Australia and New Zealand. But enough about that. My job today is to talk to you about what we think is happening in the economy. That's my whole gig at Rabobank. I go around and I talk to our clients and our partners about what we're seeing in the economy. And obviously, we've been through a really challenging period. We're still in a challenging period, but we think that we're entering a slightly different phase in how things are looking going forward. So we'll get into that. But before we do, the most important slide in my deck is always this one here, our disclaimer. So before we launch in, I'll just say that everything that you hear from me today is general in nature, for information purposes only, is not intended as financial advice and certainly shouldn't be taken as such. I haven't consulted anyone's personal circumstances when putting this together, so please do receive appropriate advice before you act on anything that you might hear from me today. Okay, with that out of the way, I think it's fair to say, and this may not be news to many of you, that if we look at the economy of Australia and New Zealand here in 2024, we're effectively living in an aftershock from COVID-19. So when COVID came along in the first quarter of 2020, effectively we had this enormous shock to the economy, and particularly a supply side shock to the economy. If you think about it, what happened? The virus turns up, we started doing things like putting cities into lockdown, closing international borders, we were closing workplaces, some people were working from home. And effectively what that represented was a big shock to the supply side of the economy. Effectively, we were producing far fewer goods and services almost overnight. So the supply side dropped in a big way. Now, in response to the crisis of COVID-19, we saw that a number of governments and central banks around the world, almost all of them, and the government of New Zealand and the government of Australia were no exception to this. They stepped in and they provided support to businesses and households by providing wage subsidies, cutting interest rates to almost zero, and providing various stimulus payments to try to keep firms going and try to keep households connected to their jobs. So effectively what we've seen is a big downward shock to supply and a big upward shock, or at least a treading water of the demand side of the economy. And when supply and demand get out of balance, when demand exceeds supply, you have scarcity. And the way that we solve the scarcity problem in a capitalist economy is through the price mechanism. And as a result, we had this big inflation shock. And you can see that in my graph on the right. That's showing us what's going on with inflation rates in New Zealand and Australia. New Zealand being the orange line and Australia the blue line. Now, there was another supply-side shock that came along when Russia invaded Ukraine. That particularly had large impacts on the energy complex, and that fed its way into transport fuels and other things like fertilisers. So we saw a big shock on price inputs as well. And then New Zealand had an idiosyncratic shock, something unique to New Zealand when Cyclone Gabrielle came along in the first quarter of 2023. So you might notice that New Zealand's inflation curve is sort of wider and it drops, or it sort of rises more quickly, but then it sort of stays high for a longer period of time. And that's probably because the New Zealand economy is a little bit less complex than the Australian economy, so it's not as flexible. But also it had an extra supply-side shock from the cyclone that we had to deal with here. So that's the lay of the land. My graph on the left, that's showing us what happened with GDP growth. We had the big downward shock early in the pandemic, and then we had the sort of the opening of the doors, all the stimulus washes through, and really, really high growth rates. And ever since, we've been tailing off And here in New Zealand, we've had a double dip recession. We've had 2 recessions, and we might be in a 3rd recession at the moment. We'll figure that out when we get the growth figures for the 3rd quarter of the year. But Australia, unusually, hasn't recorded a single quarter of negative growth so far. Growth hasn't been high at all, but it hasn't been negative. So slightly different situations between the 2 economies. Now, when we think about some of these supply-side shocks that were going on with COVID-19 and the Ukraine war, that situation around the world, it created winners and losers. And there's a bit of a cliche about Australia. I'm sure that many of the Australians in the room would have heard this before. We sometimes get called the lucky country, and sometimes it's better to be lucky than good. And we certainly saw that during this supply-side shocks that we saw washing through the economy. So the war in Ukraine particularly impacted on some of the prices of the things that Australia sells to the rest of the world. And all of a sudden, certain commodities particularly were big winners from what was going on. We saw prices for oil and gas, thermal coal, grains and oilseeds really rocketing higher throughout this period. And that was good news for Australia, because those are things that Australia sells to the rest of the world. Unfortunately, there were losers created throughout this period as well, and particularly tourism. It's hard to have much international tourism when international borders are closed. Education exports, the university sector really suffered during this time period. The forestry industry has been under a bit of pressure since we've seen construction rates really drop off. And also animal protein and the dairy industry, which are both quite important for the New Zealand economy, were under a bit of pressure throughout this time period as well, because we saw less demand out of China owing to the lockdowns that were happening over there. So to put all of that in a nutshell, effectively what we saw is that the terms of trade of Australia went through a little bit of a boom. This is the relative prices of the things that Australia sells to the world versus the prices of the things that it buys. It went up. While the terms of trade of New Zealand actually declined a little bit, and it's still not quite back to where it was immediately prior to the pandemic. So we had this divergence in fortunes happening between the 2 countries in this time period. Now, also, when we have an inflation shock come along, we tend to see a policy response from governments and central banks, and I'm sure that will come as no surprise to anyone in the room. We've seen quite a few interest rate hikes from central banks in New Zealand and Australia since October of 2021, when the RBNZ first started raising the OCR. And really there's 2 slightly different approaches that have been taken by the 2 central banks, and they've yielded different results. So the RBNZ hiked earlier, they hiked harder. So we took the OCR up to 5.5%, and we started in October of 2021 here in New Zealand. The RBA was much slower off the mark. They were slow to get going. They didn't start hiking the RBA cash rate until May of 2022. They hiked 13 times. And they only took the RBA cash rate up to 4.35%, which is where it remains today. Now, effectively what we were seeing here is a difference in approach between the RBNZ and the RBA. The RBNZ, they have a single mandate. Their job is price stability, get inflation within that 1 to 3% target range, and ideally back to 2%. For the RBA, they have a dual mandate. They have to look at price stability, but they also have to look at full employment. They have 2 jobs, and those jobs pull in opposite directions. So as a result, we saw that the RBA went much easier on trying to win the inflation fight, but that has protected the economy. That's part of the reason why Australia hasn't recorded a single quarter of negative growth, and we're not seeing the rise in unemployment in Australia to the same degree that we're seeing it in New Zealand. Now, the downside of that approach is that inflation is much more persistent in Australia than what it is in New Zealand. So as we look at New Zealand today, we're already seeing cuts to the OCR flowing through from the RBNZ, and we're expecting that when the RBNZ meets next month to set the OCR, it will be at least a 50 basis point cut. There's some probability, around about a 50-50 probability according to financial markets now, that they might even cut by 75 basis points. So either way, we're going to see the OCR drop below the RBA cash rate in November and then continue to head lower from there. The RBA, by contrast, we're not expecting them to be in a position to cut interest rates for quite some time. Our expectation is not until May of next year, and even when they do start, they can probably only cut rates maybe 2 or 3 times. So quite different. Now, as I mentioned, the OCR is likely to fall below the RBA's cash rate by November. And as a result, when we start seeing interest rate cuts flowing through quite quickly, we start to see that consumers become a little bit more confident about their situation. We know that in New Zealand, if we look at the structure of the mortgage market, people are borrowing a lot shorter than what they normally do. Typically, Kiwi households, they have fixed rate loans for sort of 2 or 3 years. But now all of a sudden, around about 70% of the total mortgage book is on a loan period of either variable or fixed for less than 9 months. So that means that the interest rate cuts will flow through to money in people's pockets more quickly. And as a result, we're starting to see consumer confidence. My graph on the right is picking up, and we would expect that will continue to pick up as the RBNZ delivers on some of these aggressive cuts to the OCR, more money in people's pockets, and hopefully that will mean that we'll start to see a little bit more household consumption growth, more spending, more demand for goods and services, and more economic growth. So we think that is in the months and quarters ahead. Now, New Zealand, having taken this particularly tough approach to winning the inflation fight, obviously it has had impacts. It's had impacts on unemployment. We're seeing the unemployment rate in New Zealand at last measurement, 4.6%. We'll get an update on that in a week or two, and we're expecting it to head higher again. Whereas in Australia, where interest rates have been kept relatively low, the labour market is still really strong. There's still strong job gains happening in Australia. And in the most recent data, we actually saw the unemployment rate fall from 4.2% down to 4.1%. So that's another difference between the two economies. In Australia, consumption is being supported by a really strong labour market. If you've got a job, you're receiving a wage, you've got more ability to go out there and spend. Whereas in New Zealand, one of the risks that we do see to rising consumer confidence and rising confidence to go out there and spend is if the unemployment rate does continue to increase quickly, then that might limit the ability of households to actually go out and spend more money. So that's a little bit of a risk. One thing that does have New Zealand well positioned, though, is, or at least we think, is on the productivity side of things. So there has been very little productivity growth in either Australia or New Zealand for a number of years. So New Zealand's productivity is back to 2013 levels. Think of productivity as how many outputs you can create with a given number of inputs. So we're back to 2013 levels, and that's bad news because the only way that you grow living standards in the long term is through productivity. In the short term, we can increase productivity through increased capital investment, and I was glad to hear Nick talk about that. That's very important. But over the longer term, we look at things like technological growth as helping us to raise productivity and raise living standards. Now, Australia's productivity has been quite low as well. We're back to 2016 levels in Australia. But I think that New Zealand is actually particularly well placed to grow productivity here onwards because you've done the hard yards, the tough pre-season training, and I couldn't come to New Zealand without trying to work a rugby reference into my slide pack. So gratuitously, that's it there. So New Zealand has done the hard yards. We've effectively forced businesses to find efficiencies in their operations through increasing the cost of capital and the difficult operating environment. It really focuses the mind when you have a trading environment as difficult as it has been recently. And we think that as a result, New Zealand businesses might actually be better placed than Australian businesses to grow their productive capacity sort of coming out of this economic shock. So that's something that we'll certainly be keeping an eye on over the next 6 to 12 months. We think that New Zealand might begin to outperform. Now, that's the productivity side of things, which ultimately leads into a higher speed of economic growth. If you have higher productivity, you can run a higher growth rate without generating inflation. But there's also potentially some good news for the New Zealand and the Australian economy on its way from China. China is the major trading partner for both countries, very important for the economic fortunes of both New Zealand and Australia. And what we're seeing in China at the moment, the economy had kind of stalled as it came out of the COVID period. We saw the end of the COVID zero policies in December of 2022. All the lockdowns were eventually removed, and the economy kind of stalled on the grid. It didn't really get going. Now we're starting to see a concerted effort from the Chinese central bank and the Chinese central government to provide more stimulus into the Chinese economy, particularly the real estate sector, which is very important for household wealth in China. About 70% of household wealth is tied up in real estate. And we're seeing a number of interest rate cuts to key policy rates, and that's what I've got on my graph here. These are all key rates in China that have been cut recently. And we're also seeing lots of liquidity being provided to the banking system by the People's Bank of China. Now, all of this is aimed at supporting the real estate sector, the stock market, and ultimately household consumption. If you have more household consumption in China, they're buying more of the products that New Zealand and Australia export to them, and then that flows through to higher economic growth and higher incomes here at home. So we see that as a big positive demand shock potentially coming out of China. So a little bit of a gloomy picture in some of the slides that I went through before, but we think that there are brighter days ahead. The economy will start to grow more quickly. We'll start to see more consumption from Kiwis and Aussies. And there's also, we think, help on the way from our friends in China who are stimulating their own economy, and that will have flow-through benefits to the rate of economic growth here at home. So with that, I'll wrap up. That's everything I have for you today. Thank you very much for your attention. It's been a great pleasure to be here.